Hello everyone. Good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the earlier session of the chapter PGBP, Head of Income, we discussed about the charging section of this Head of Income, that is 28. What types of incomes are all chargeable to tax under this head, and which are the incomes not taxable under this head, and what are the other general things that we should observe while learning the aspects of PGBP we have discussed in the earlier session. Now let us continue this conceptual discussion only before entering into the real provisions, because this helps a lot in understanding the provisions easily and remembering them easily rather than just going blindly. So first, certain points we can understand as principles rather than as provisions. What are the basic principles that we should observe in this particular head of income? Are some of them and most of them are logical only, nothing special. Of course, the business must be carried on during the previous year. That is one of the basic principles. Just like you can relate to the income from house property also, the SSC should be owner of the property during the previous year normally. Same way, when we are talking about an SSC having a business income under the head of PGBP, he should have carried the business, right, during the previous year. Then only there is PGBP. Otherwise, how there will be PGBP? So that's the basic thing. But point is special cases. Normally, the business or profession should be carried on during the previous year, no doubt. But is it necessary that it should be carried out throughout the previous year? Definitely not. Or is it necessary that it should be carried on till 31st March of the previous year? Definitely not required. Any point of time in the previous year, if the business is carried out, that is enough. Not only that, in addition to this logic, there are certain types of receipts which are taxable even if no business or profession is carried on by the SSC during the previous year. Once again, you can relate the things. Logic to logic, not provision to provision. Don't relate everything like that. Logic to logic, it is the same logic, right? For example, in the case of, let us say, unrealized rent or arrears of rent received by the SSC during the previous year, such amount will be taxable in the hands of the SSC even though he is not the owner of the house during the previous year. Same logic here also. That means section 25A, as it was as exception to the charging section of 22. Same way, there are many cases in the PGBP also wherein the SSC might not be carrying business during the previous year, but still the following receipts could be taxable in the hands of the SSC under the head of PGBP, in spite of the fact that the SSC does not have any business during the previous year. That is the point to be noted. What are those special cases? Of course, we will look at them, all of these points when they come anyway. But the question itself theoretically can be asked like this. What are the cases where the business need not be carried on by the SSC during the previous year for having certain types of incomes to be taxed under the head of PGBP? What kinds of incomes are those? These are the kinds of incomes. And once again, I'm telling you, if you observe the logic behind them, logic will be same. Points are different. The logic will be same. What is that? Let us say the recovery or excess recovery against a deduction or a bad debts. Same logic. Let us say in some past year, 5 years back, bad debts was debited to P&L. It was allowed as deduction, or for that matter, any other deduction. Not only bad debts. Bad debts is only one of them. Any deduction that was allowed earlier. Now what happened? Recovery of that happened. When that was a loss earlier, some time back, SSC claimed a deduction. Later, after some years, that was recovered. But at the time of recovery, business is gone. Already SSC has closed the business. But somehow, one of the customers realized his mistake and he religiously came and gave the money that he was supposed to give to the SSC during our previous year, wherein the SSC doesn't have any business also. What should we do? Still that will be taxable because the same amount was allowed as deduction earlier. Now the situation got reversed. That is a logic, not the provision. Provision is what? If there is a bad debts or any other deduction given earlier, and if there is a recovery or excess recovery against such deduction, then such recovery shall become taxable in the previous year, even though the business or profession is not carried on during the previous year. That is one of the special cases. Same way, for a power generating unit, if it sells the depreciable assets, then also not necessary that the power generating unit need to carry the business during the previous year. Why is that and all we will discuss when such topic comes. Same way, the sale of assets was used for research under section 35. We will come to that also. These are all separate areas which we will discuss in this chapter, but even in this case the logic is same. Scientific research is such a variety situation where for a capital expenditure also you can claim deduction. SC has claimed deduction already earlier. He has purchased some building and machinery and all, claimed a deduction for that capital expenditure earlier under section 35 for scientific research. After 1 or 2 years, he closed the business and sold those assets. Happily claimed the deduction that year earlier. Now, he sold the assets means the sale proceeds of that assets will be chargeable to tax under PGBP. He cannot sell that. If he sells that, that will be taxable. Since he claimed deduction earlier, once again the logic is same. Now the situation got reversed. Same way, last one also. Say, reserve was created earlier. Some reserve is there that is created and now it is withdrawn. Reserve created, you claim a deduction. Now it is withdrawn, taxable. Same way, all of the 4 points almost having similar logic. You claimed a deduction earlier, now the situation got reversed, so it becomes taxable in spite of the fact that SSC does not carry business during the previous year. Of course, if sum is received after the discontinuance of a business or profession, also it would be taxable. Not necessary that all the payments will be received while the business is in continuation. Let us say last year, prior to the previous year, SSC has discontinued the business. Still he has a lot of money to receive, but he did not account for it and that is gone already. After the discontinuance of business, he received something. That will become taxable. If it was already accounted for and taxed, once again it cannot be taxed. If it was not accounted for earlier, now if it is received after the discontinuance of business, because it is income, that will be definitely taxable under PGBP only, irrespective of the fact whether the business was carried on during the previous year or not. That is a first general principle we can say. Second one is, of course, the business has to be carried on by whom? The SSC, not by his uncle or neighbor. Definitely, he is himself, SC, has to carry on the business. What is the big deal in that? And this also we know, the income of the previous year is taxable in the following assessment year. All these things we know already, most of them. And tax incidence arises in respect of all businesses or professions. We are not defining any particular one type of business, any profession. That will be coming under the purview of this head of income. And other things also we know. Legal ownership should we look at or beneficial ownership should we look at? Always beneficial ownership under income tax law. Legal ownership is not required. Beneficial ownership, substance over form. That is a fund of income tax law. So, beneficial ownership is more than legal ownership. Same way. Should we take real profit or anticipated profit into consideration? Of course, real profit we have to take. How can we take anticipated profit, future profit, expected profit, dreamed profit? No, those things cannot be taken. Same way, notional profits cannot be taken. This is not a notional head of income. PGBP is a real head of income. Actually, whatever happened, that only becomes taxable. Of course, that does not mean it is taxable on receipt basis. It is taxable either on receipt basis or on accrual basis according to the method of accounting carried on by the SSC and according to the choice of the SSC. So, notional profits, anticipated profits cannot be taxed. Real profits only can be taxed. And same thing once again repeated. If there is any sum or any amount that was already allowed as deduction, if at all there is a recovery of that, always it will be taxable as business income, because earlier you claimed deduction under PGBP. Now, if you recovered that, it will be taxable under PGBP only. How can it be taxable under any other head? It will be taxable under same head. Deduction was under this head. Taxability later also will come under the same head of income. And very important point to note, book entries is not relevant. Some SSC will say, I did not do any entry for this. Who cares? Whatever the transactions are happened, there has to be entries for that. There has to be books of accounts maintained for that. But how he maintains, what is his policy, I will treat this as capital expenditure according to my policy. No, not according to your policy, not according to accounting standards, not according to the whims and fancies of the SSC. It has to be followed according to the Income Tax Act, PGBP, head of income, and of course, there are certain standards prescribed by the Income Tax Act also, though we don't have them in syllabus, but just to note that there are some accounting standards type of situation, even in Income Tax Act also, those are called as ICDS, Income Computation and Disclosure Standards. That is ICDS. So, according to that, SSC has to follow, not according to his own accounting policies. Oh, it is my customary thing that I always do like this only. It doesn't matter. All those things are irrelevant. Simple point is, SSC has to follow ICDS if he follows accrual system of accounting. If he doesn't follow accrual system of accounting, if he follows cash system of accounting, there is no problem with entries. Cash received, then only it is income. Not received, there is no income. Amount paid, then only it is expenditure. Not paid, there is no expenditure. So cash system has no problem at all. Issue comes only with accrual system, where people will do creative accounting. That is not allowed. Point is, you have to follow ICDS. The SCs have to follow ICDS, not other things, and not their own policies and accounting standards, Companies Act. All of them they can do very well, fantastically. But that is for their own annual financial statements for the purpose of public. Those are different. What profit has to be computed according to the Income Tax Act is completely different. So the book entries are not relevant. Then, as we already know this also, legal, illegal business, we don't differentiate. Business is business. Anything is taxable. Okay, it's a different story. No illegal business person is going to come and say that, oh, take this is my illegal business profit, I'm declaring it. Nobody is going to declare that. It's a different story. But point is that it is also taxable. As far as taxability is concerned, there is no distinction between legal business and illegal business. Any business, legal, illegal, speculative, non-speculative, doesn't matter. All of them are taxable under PGBP only. That is a point to be understood here. And not only the expenses, certain losses which are incidental to the trade also are allowable as deduction. Expenses are mentioned in section 32, 37. What are allowed as deduction? Losses always will become a litigation matter. So, what the law says is, losses incidental to the trade are allowable. Naturally, again a question comes, what is incidental to trade? Debatable issue, grey matter. Courts will decide that most of the cases. For us, because we cannot go to court from exam hall, we have to decide according to our judgment, with our logic, whether it is incidental to business or not, if at all such situation happens. But principle, at least definitely we should know, losses or expenses, both are deductible. Expenses are deductible according to 30 to 37, whatever mentioned in those sections. Losses are also deductible if those losses are incidental to the business of the SSC. For convenience purposes, we will also look at a list of those losses immediately after this next discussion of what are the principles for computing the business income. Basic principles, once again, common sense, basic accounting, and conceptual clarity. That's all. Nothing law here. Simple point. Capital receipts are not taxable. Naturally, capital receipts cannot be called as income. Capital receipts are not incomes, right? Those are not incomes. Let us say a company has issued share capital or taken a loan. That's a capital receipt. How can that be income? That cannot be income. That is not taxable. So the profit can only arise out of trading means, don't take it too literally. Trading receipt means business receipt. That is a revenue receipt, I would say. Then, of course, we know this also. Profit element is only taxable, not the entire receipt. Receipt is gross. That is revenue. Revenue is not what is taxed. What is taxed here under PGBP is profit element. That means revenue minus of expenses. And as we just now understood, trading losses of revenue nature incurred in carrying out the business are also deductible. Same like the 11th point above. And another important point, the trading loss is deductible only in the year in which it is incurred. Suddenly you cannot come and say, 4 years back I incurred some loss, I forgot then, now I think I will take that as deduction. No, not possible. Expenditures can be related to the previous year only. That is why it is revenue expenditure. Losses also, if they have to be claimed as deduction, they have to be claimed as deduction in the year in which they are actually incurred naturally. Otherwise, what people will do? They will tell in some of the years, let us say profits are not that much, tax payable tax or the tax liability is less. They will be just silently filing the returns. Suddenly, imagine in 1 year the profits are too much and tax liability also is too much. SC will suddenly come and say, actually 4 years back there was a trading loss. Now I will claim as deduction. To reduce his profits, he can do all these gimmicks, which is not possible. Trading losses are deductible only in the year in which they are incurred. That's also an important point. If at all in the questions it is given that loss of 4 years back or 3 years back or other than previous year, the loss is related to and that was debited to P&L, you have to understand that is not deductible. In other words, we have to add it back if we use indirect method. If we use direct method, it should not be deducted at all. That is another important point to be noted. It's principle actually. While computing the business income, these are the principles that we should follow. Of course, capital losses are not deductible. See, capital losses, capital expenditures are not deductible. Capital receipts are not taxable. Only revenue receipts are taxable. Revenue expenditure is deductible. And losses of revenue nature only are deductible. That too if they are incurred in the same year, that is our previous year only. And PGBP is a net concept, not a gross concept. Revenue is not what is taxed here. What is taxed is the profit element. These are the basic principles that we should keep in mind while computing the PGBP. And this head of income requires these type of conceptual things also to be kept in mind. As I said earlier, this is not purely a provision based head. Provisions are too many, but at the same time with common sense and logic also we can identify whether a particular item is deductible or not. Does it have some point whether it is taxable or not? Those points also have to be noted and known. That is why we are looking at the principles rather than provisions. Provisions anyway we will look at them in the upcoming classes. Now before going to them, there are some trading losses which are deductible from business income. All of them are court cases. Court cases. So we don't need to know which case and all. That will be required at final level. We don't need to know that. But common sense once again we have to apply in each case. Point is these are deductible. Means what the court said, these type of losses are okay. SC can claim the deduction. Like this, hundreds, thousands of cases will be there. We don't need to know all of them. The books which are containing all the cases majorly will be related to which rate of income. Naturally, PGBP only. Salaries, what will be litigation? Somebody will say that my gratuity exemption is not correct. You only calculated now. So what is there in that? So there is no dispute generally in salaries or income from house property. Capital gains, yes, that is a litigating chapter also. But on a regular basis, daily basis, so many companies, businesses, organizations, where the litigation will be mostly naturally in the head of PGBP. So we don't have to go into the details of all the judicial pronouncements, but only for understanding at a broader level of what types of losses are deductible, let us go through this list of them. Once again, we can easily identify why also. Sometimes there is no why also because the judge felt so. Most of the cases there will be logic. Loss of stock in trade as enemy action, destruction by an act of God. Just like Oh My God movie. Act of God happened, stock in trade was lost. Insurance and all is not there, gone. So, is that loss deductible or not? Court said, yes, it is deductible. Then, loss due to failure to accept the delivery of goods. SSC was supposed to really receive some goods. He could not receive the goods for whatever reasons, because of which he incurred some loss. Looks like fishy, something wrong, some shady thing had happened. That's what a SC officer said, and he said, no, I will not allow this as deduction. Court said, Baba, it happens sometimes. No, it's a failure to accept the delivery of goods. It's a mistake by the SSC. It does not mean that because of that mistake, the loss that he has incurred is not deductible. You cannot say that. That is also deductible. Then, the depreciation in the funds kept in foreign country for purchase of stock in trade. Depreciation here means not that depreciation. Devaluation we can say. the value of currency, foreign currency, what is kept for the purchase of stock in trade, because of the changes in the fluctuations of the foreign exchange rates, the value of that money has gone down. What we can do with that? There is a loss. Simply speaking, foreign exchange loss while purchasing inventories. Whatever it is, stock in trade is only one of the examples. For anything, foreign exchange loss while purchasing the stocks, is it allowed as deduction? Yes, it is allowed as deduction. Same way, if any loss is there due to the exchange rate fluctuation held on revenue account, so not only this stock and trade, that is why it is extended to any other revenue expenditure also. If there is any loss due to the exchange rate fluctuation, that is allowed as deduction. That itself tells us, if there is any loss due to exchange rate fluctuation for capital account, for example, somebody has incurred exchange rate fluctuation loss while purchasing a fixed asset, can that also be considered as a loss here? No, that is not allowed as deduction. That should be adjusted with the fixed asset's value itself. If it is a loss, the fixed asset value should be increased. If there is exchange rate gain, the fixed asset value should be decreased, but it should not be debited to P&L. I'm not talking accounting. When I say debited to P&L means it is not deductible. That's what I mean to say. So, if the loss is incurred on revenue account, it is okay. That is allowed as deduction. Same way, loss on the sale of securities held on the regular course of business, naturally allowed as deduction, because if that is the business of the SASI, securities will be his stock and trade. Stock and trade is a concept to be understood very clearly. Stock and trade means the goods in which the SASI deals with. Furniture is a stock and trade for a furniture shop owner. Same way, jewelry is the stock and trade for a jeweler. Buildings is stock and trade for a real estate developer. Like that, securities is a stock and trade for a person who has a business of buying and selling securities, and he incurs some loss on that. That's it. That is okay. That loss is allowed as deduction because it's a business loss. That is his business. So it is allowed as deduction. Loss of cash or securities due to dacoity. So somebody has come to SASI's place and stolen some cash or securities or assets. Because of that, SC has incurred some loss. Can that loss be claimed as deduction? Of course, yes, it can be claimed because it is also incidental to business. SC did not do any mistake, right? Somebody has come and stolen it. What SC can do? He cannot do anything. For that, you cannot punish him by disallowing that expenditure or loss. So the court said it should be allowed as deduction. Same way, loss on the realization of amount advanced for other businesses. If at all any amount is advanced for other business and other business bankrupt, and we incurred a loss because of that. We could not realize that amount. Naturally, it is a loss, no problem. That will be allowed as deduction. Loss of securities deposited for acquisition of stock in trade. Once again, same. If at all any securities are given to the supplier for the purpose of acquisition of stock in trade and those are lost, these things are not possible nowadays because it is all demat accounts which are all there. So no need to worry about them, but yes, that is also a loss incidental to business. Loss due to theft or burglary, names different, dacoity, theft, burglary, all losses are allowed as deduction. This was a case actually, loss of precious stones or watches of a dealer. It is not his personal asset. We are talking about a dealer in watches. Let us say a diamond merchant is there, and a diamond merchant, while bringing those diamonds to his home, somebody has stolen those diamonds and he incurred a loss of that. That is loss of stock in trade only for him actually. Should that be allowed as deduction? Of course, yes. You may say a lot of conspiracy theories. Maybe he himself has kept it somewhere, or somebody like Pizza movie, somebody has stolen from him, or maybe he knows that already it is there somewhere. All these things can be conspiracy theories. The point is these things have to be proven, right? We have to understand that. These are all the things when we say loss of precious stones is there. He has to prove that it is really lost. Just like that, he cannot say, oh, I incurred loss. Anything that the SSC wants to claim as deduction, that is his responsibility to prove. So, main point here, we'll come to that anyway. Onus of proof is always the responsibility of the SSC. So, these things will not happen just like that. But because we are only talking about books and classrooms and exam halls, we don't need to worry about the realities. It is their headache to prove it, that these losses have really happened, and if they really happened, they can claim as deduction. We are only talking the principle there. We are not telling that whether really happened or not. We are not police or CBI to investigate that. That is not our job, and that is not the job of Income Tax Department also. If the SSC can prove, then only he can claim deduction. So it is basically the responsibility is not on the department, it is on the SSC to prove that really that he has incurred a loss. Same way, if there is a loss due to the negligence or dishonesty of the employee. So the employee has taken some cash and embezzled some cash and left. Happens sometimes with cashiers sometimes and all. So loss happened. Is it allowed? Of course, yes, it is allowed as deduction. No problem. Insolvency of a banker, allowed as deduction. Freezing of stock and trade by enemy action. Some war happened, because of that stock and trade could not be sold. Loss happened, allowed as deduction. And this is an interesting thing. Non-recovery of advances given to a 100% subsidiary company also is allowed as deduction. So what happened? A holding company has given an advance to subsidiary company. Subsidiary company did not give it back. Holding company incurred the loss. So that loss is allowed as deduction in the hands of the holding company. This is a loophole, definitely. If this court judgment is used, a lot of people can create a subsidiary company and show some amount as advance given to them, and it did not pay back. Because it is 100% subsidiary, people who are involved in both the companies will be same. In a sense, they can evade the tax by using these type of judgments. Of course, not necessarily that the same judgment will be upheld in another case also. It all depends upon the facts of the case. We cannot consider this as law directly as an act or a provision. No. In that particular case, it was allowed as deduction. That does not mean that court will always give the same judgment in all cases. If that is a case, if that is a way courts function, there will not be those many cases now, right? But still, why there are cases? Sometimes the judgments will be different also. Anyway, this particular judgment would have been given in a genuine case where really the holding company has given some amount advance to the subsidiary company, and subsidiary company really became bankrupt and it could not pay back. And the holding company is a big company; it must be a profitable company. Subsidiary company would have become a flop. What they can do? So that is a genuine loss, they thought, and they said it is allowed as deduction. But yes, that's genuine thoughts. Genuineness has to be proven, not that automatically that is all assumed. And a similar thing, the loss incurred by a holding company for a guaranteed loan from its subsidiary. So same logic. Subsidiary company took a loan from a bank. Who gave guarantee for that? Holding company gave a guarantee for that. Subsidiary company failed to pay to the bank, and naturally the bank will ask the holding company, and holding company is incurring loss because of that. Holding company did not have anything. It did not have any loan itself. It only gave a guarantee of the loan from somebody else to its subsidiary. Still it incurred loss because subsidiary company failed to repay that loan. No problem. Still that is also allowed as deduction. These are some of the examples only. Again, I'm telling you, there will be thousands and thousands of cases. We don't have to really go through all of them. And even in these cases also, we don't have to really identify or remember what is the name of this court case. In final level, yes, these all case laws also have to be remembered at that level. At this level, I would say, understanding the common point, the thread between each of them is enough. Most of them, in fact, all of them are having logic. None of them is like completely ridiculous, except the last two, which are questionable. If the holding company would try to take advantage of these judgments, that depends upon such individual cases. Anyway, these are deductible. Now coming to the other side, what are the trading losses which are not deductible from business income? Opposite will be there naturally. Loss which is not incidental to the business. If it is not incidental to the business, it is related to something else. How can that be deducted from the business income? Not possible. Same way, capital assets got destroyed or damaged. Capital assets is capital assets, not revenue nature. That is not a revenue item. That is a capital item. So naturally that comes under the purview of the chapter capital gains, not under the purview of PGBP. Same way, the loss due to the sale of shares held as investment. Earlier also, this point was there. Loss due to sale of securities held on regular course of business. That is different. In that case, securities were the stock and trade of the SSC. In this case, securities is not stock and trade, it is investment. Then that comes under the purview of capital gains. simple point always we have to keep in mind. Whether a particular asset is falling under the purview of PGBP or capital gains will not depend upon the name of the asset. It depends upon the nature of the asset. If it's a building, how do you know whether it is a capital asset or not? We don't know. Maybe it is a stock in trade. For a real estate dealer, for a developer, it is only a stock in trade. Same way, shares. It is possible as investment also, it is possible to be a stock in trade also. Jewelry. Normally it could be only like a normal capital asset. But for a jewelry dealer also, is it a capital asset? No. For him it is stock in trade. So the difference between stock in trade and capital asset is very important to identify, because conversion of one to other will attract that particular head of income, as we discussed yesterday's class also. If stock in trade is converted into capital asset, it is taxable under the head of PGBP, and how much is taxable is the fair market value of such stock in trade on the date of such conversion. Of course, when we know this, we can know the reverse also. If capital asset is converted into stock in trade, then it will be taxable, but not here. It will be taxable under the head of capital gains. How much will be taxable? Same once again. How much ever is the fair market value of that capital asset on the date of conversion. So, capital asset, stock in trade. This discussion is very, very important for simple reason, because it covers 2 chapters in one shot. So, very much clarity is required in that area. So, here in the third point, when we say that shares are held as investment, that is not stock in trade, that is a capital asset. So, naturally, it will not form part of PGBP, and the loss incurred in that respect will not be deductible under PGBP. Right? This is another important point. This one will be given sometimes in the exam questions also. It was given also. Loss due to advances made for setting up of a new business which could not be started. This is a variety situation. Let us say SC has given an advance or some money to somebody to start a new business, and that new business could not be started at all, and because of that SC lost all the money that he has advanced to somebody else. Can't help it, that cannot be allowed as deduction, because the loss should be incidental to the business. And which business? An existing business. If not existing, at least a past business is okay. Discontinued business also is okay, at least for taxability wise. But deductibility wise, the business should be existing. Future business, new business, which could not be even started. It is not real business, it is a potential business. And if any loss is incurred towards a potential business, future business, possible business, there is no deduction that can be claimed from the existing business. Very, very important point. And same way, the depreciation of funds kept in foreign currency for capital purpose. As I told, if money is kept for purchase of fixed assets, that is a capital purpose, capital expenditure. And money means not Indian currency, foreign currency. And because of changes in the fluctuation of the foreign exchange, there is a loss incurred in that funds which are kept in foreign currency for the purpose of purchase of fixed assets. If that loss happened, that should be added to the value of fixed asset. If there is a gain because of that, that should be deducted from the value of fixed asset, but it cannot be deducted here from the profits. No. That is why that is a non-deductible item from the business income. Then, one more thing. If at all there is a loss due to non-recovery of tax paid by an agent on behalf of the non-resident. So, if the agent has not paid the tax on behalf of the non-resident, and because of that non-resident has incurred some loss, that cannot be allowed as deduction. That could be a very special case. In the court, it was not allowed as deduction. We don't need to go into the details of that. Future losses, of course, cannot be allowed as deduction. And losses related to the business discontinued before the commencement of the previous year cannot be allowed as deduction. If there is a discontinuation during the previous year, no problem. Let us say SC has done business up to September. After that, he discontinued. Losses related to that business is allowed as deduction in the previous year, because in the previous year also the business was carried on. But what if the business was discontinued even before the commencement of previous year? Then how can the losses related to that business be claimed in the previous year? Not possible. So discontinued business before the commencement of previous year, if any discontinuation happened, losses related to such business cannot be claimed as deduction. Same way, losses related to future cannot be claimed as deduction. Losses related to a potential business, possible business, cannot be claimed as deduction. That is about some of the aspects related to deductibility or non-deductibility of losses. We are not talking expenses. Expenses will be covered in section 32, 37 anyway. Prior to that, we are looking at the losses which are deductible or not deductible. Now coming to the question, whether cash system or mercantile system has to be followed. Option is given to SSE only. There is no rule by the Income Tax Act that SSEs have to follow mercantile system or accrual system. Another very important distinction between accounting and taxation. In accounting, accrual concept is one of the fundamental accounting principles. So always accrual system is followed in accounting, what we normally do. And even in the Companies Act also, it is mandatory that companies have to follow accounting standards. And because accounting standards tell that it is mandatory to follow accrual concept, indirectly Companies Act also tells that accrual system only has to be followed by the companies. However, under Income Tax Act, there is no such prescription, irrespective of the type of SSE. Income Tax Act does not worry about other acts and other rules, other accounting standards and all. We don't care. Whatever Income Tax Act says, that only final for us in this subject. What it says, because it is your choice. You want to follow cash system, you follow. You want to follow mercantile system, you follow that. It is option given to the SSE. That much freedom Income Tax has given as far as method of accounting is concerned. Of course, generally, most of the people who do any scientific accounting, they follow accrual system. A lot of small traders and all, they follow cash system. But that is not a problem. That can be followed also. So cash system or mercantile system at the option of the SSE. Option of the SSE does not mean 1 year I will follow mercantile, next year I will follow cash. No, not like that. Whatever the option is, that has to be continued. That cannot be changed by the SSE year after the year. That should be consistently followed. That is about method of accounting. That is section 145 actually. Anyway, coming to the definitions of the business or profession, we don't need to really go through the definitions in detail, but it just tells us a broader perspective of what is business. Business includes any trade, commerce or manufacture or any adventure or concern in the nature of trade, commerce or manufacture. Anything is business. Profession includes vocation, he says. Vocation also is a profession. Not necessarily profession means they have to do only for the purpose of commercial things. Even hobby also, even a vocation also, even let us say a singer is there. He may say that I am doing for my soul satisfaction. No problem, Baba, but because of soul satisfaction, you are also getting money, right? Pay tax on it. So that is also profession. Somebody says, just let us say, giving pravachanams and all is my vocation. I like to do that. No problem, you do that. Anybody can do anything in this country. But if you get money from that, you pay tax on that because it is also a profession. So profession includes vocation, and any other art forms also will be considered as profession only. Business includes trade, commerce or manufacture or any adventure or concern. Means not necessarily it should be a continued effort. Even a short-term adventure also in the nature of trade, commerce, manufacture can be called as business. That is a common definition. Across the acts, Income Tax Act also will have more or less the same definition. GST also will have the same definition. Even in future Customs Act also will have the same definition. So business and profession are very commonly defined, generally like that. No very big details there. So people should understand business means business, profession means profession, like that. More or less it is like that only. There is no much stress on the definition part of those two terms. Now coming to the deductions, which is the crux of this chapter. Once again, before entering into the provisions related to deduction, let us understand the general principles for deduction. General principles we have to understand. After that, we can also discuss about the real provisions contained in section 30 to section 37. And what we are now discussing is only a general discussion, not really any provision. First and foremost point is onus of proof is on the SSE. Onus of proof, burden of proof, responsibility, all of them are similar. That is whose responsibility to prove that there is an expenditure? SSE. SSE cannot say, oh, I have incurred crores of expenditure and I will debit my P&L account. No problem, you will debit it. But what is the proof that you really incurred? That onus of proof, burden of proof is always on the SSE. If he debits something to the P&L, claims that as an expenditure as a deduction, it is his responsibility to prove that really that expenditure has been incurred. For that, you have to show documentation, records, whatever it is required by the assessing officer, you should be able to produce. Just like that, you cannot give some random numbers telling that this is my expenditure and all that. Not possible. So, complete burden of proof is on the SSE whenever he claims the deduction in relation to expenditure. And the second point is also logical one. Because expenditure should be related to previous year naturally, then only deduction will be given. Business should be carried on during the previous year naturally. These are all common things. Expenditure should have been incurred in connection with the SSE's business. It should not be a personal expenditure. It should be related to the business of the SSE. This is a very important point. And we'll also again look at that in section 37 later. But a common sense point, very much. Expenditure to be claimed as deduction means always that should be an expenditure related to the business, in connection with the business. Something else is there, I will claim that as deduction. No. SSE is a so great person, he gives a, let us say, donation of 5 lakhs rupees to some charitable trust. That is a fantastic thing. We can congratulate him, give a shake hand to him in the normal days. But do we give a deduction, allow deduction to him for that? No, because it is not related to his business. Deduction of expenditure is only possible if that expenditure is related to business. Doing charities, giving some donations to somebody else, they cannot be allowed as deduction here. It's a different story. They may be allowed as deduction later under section 80G, but that is later story. So many conditions are there also. But definitely under PGBP, it is not allowed as deduction if the expenditure is not connected with the SSE's business. Only such expenditure which is in relation to the SSE's business, that expenditure only is allowed as deduction. That is a very important point. Of course, the benefit of expenditure may extend or endure to the benefit of someone else. Someone else means not necessarily SSE, but it should be related to the business of the SSE. For example, SSE is giving a benefit to his employees. That is a benefit, right? Given to employees. That you cannot say it is not related to business. Employee is also related to business. So that benefit can be extended to someone else, not necessarily the SSE himself. But ultimately, the purpose of such expenditure should be what? That should be for business. That is one point to be noted. Of course, there is no necessity that the benefit of expenditure should be limited to the previous year, which means the benefit of expenditure may extend beyond the relevant previous year. This is also a practical point. And normally we discuss about these things in accounting. Say revenue expenditure, capital expenditure, deferred revenue expenditure. As far as income tax law is concerned, deferred revenue expenditure name is not defined, but treatment is there. Like deferred revenue expenditure for certain items, when we look at them, we will look at them. But look at, for example, some of the items, say advertisement expenditure. Example. Question always remains, should that be debited to P&L in one shot, or should that be treated as a deferred revenue expenditure? Because the benefit of advertising might not come only in the current year, it might come in the future years also. So that is a question mark. In accounting, the treatment is different. It could be anyway, according to their policy. But when it comes to taxation, it should be charged off in the year in which that is incurred, even though the benefit of that is extending beyond the previous year. So, there is no necessity that the benefit of expenditure should also result or should also be coming within the previous year itself. That is another point to be noted. And some other points like exhaustion of wasting assets cannot be claimed as deduction. Mines, quarries, like that, if at all, they are exhausting the minerals within that. That is not a loss and all. That is not allowed as deduction. So, wasting assets, exhaustion cannot be claimed as deduction. Same way, expenditure incurred before setting up of a business normally is not allowed as deduction. In case of a new business, when the previous year commences, we know that on the date when the business or profession is set up, that is the starting point of the previous year for a new business. But what about the expenditure incurred prior to the setting up of the business? That falls outside the previous year purview. How can that be allowed as deduction? No, it is not allowed as deduction. So, if there is any expenditure incurred before the setting up of the business, that is not allowed as deduction. Of course, there are certain exceptions to this. Not allowed means it is a general principle. You cannot say that we will follow general principles always. If you look at like that, general principles of income, one of the points we said that notional income cannot be taxed. And there is an entire head of income which is a notional head of income. We cannot say anything. Law says so, we have to follow that. When the law is not telling, then general principles we can follow. So, for example, like in this case of preliminary expenditure, we'll discuss that later under section 35D, where there will be expenditure which is prior to the commencement of business also, which will be allowed as deduction. That will be violating this general principle. But that is different because it is clearly, particularly allowed as deduction under that particular section, then it is allowed. If not, under normal circumstances, expenditure incurred prior to the setting up of business is not allowed. Another logical point. Same way, deduction cannot be claimed in respect of non-taxable business. When the business income is not taxable, how can expenditure be deducted? Doesn't make sense. So, not possible to claim deduction in such case where the business itself is a non-taxable business. Same way, deduction cannot be claimed for anticipated losses. Anticipated losses cannot be claimed as deduction. Okay, exception to this rule is that stock may be valued at cost or market value, whichever is lower. Just like what we normally do. Even according to accounting standard 2 also, this will be the same principle. Otherwise also, without knowing accounting standard also, stocks are always valued either at cost or net realizable value called as market value, whichever is lower. That can be okay. But otherwise, anticipated losses cannot be claimed as deduction normally. Same way, notional losses like depreciation on the investments in the shares and securities, you can call sometimes unrealized losses, cannot be claimed as deduction. Same way, appropriation of profits cannot be claimed as deduction, like transfer to reserve, payment of dividend. Those are not expenses. Those cannot be claimed as deduction. Reserves are transferred or dividends are paid after the tax is calculated, not before the tax is calculated. So, profit before tax means before the transfer to reserves and before the payment of dividend. Those are appropriation of profits but not expenses. Hence, they are not allowed as deduction. These are common conceptual points we should know. If not already, at least now we should know. Appropriation of profits is different, expenditure is different. Unrealized losses are different. If at all there are shares, let us say somebody purchased shares and it is stock in trade for him. He has purchased it for 1 lakh rupees. At the time of balance sheet, the value of the shares is in the market is only 80,000. 20,000 is loss. Can he claim that as loss? Answer is no, he cannot. That is not possible. Depreciation of investment in shares and securities cannot be claimed as deduction because it is an unrealized loss. In income tax, it is not possible. In accounting, can we do that? Yes, sir, we can do that. According to the accounting standard 13, those things are possible for certain type of stocks, particularly short-term investments, but not like that in income tax. No unrealized losses can be allowed as deduction. Realized losses, actual losses can only be allowed as deduction. Appropriation of profits are not allowed as deduction. Anticipated losses are not allowed as deduction. Losses or expenses related to a non-taxable business cannot be allowed as deduction. Expenses incurred prior to the setting up of business, no, not allowed as deduction. Same way, exhaustion of a wasting asset is not allowed as deduction. These are the points to be noted. Other points are very generic, but responsibility to prove that the expenditure is really incurred always lies with the SASI. These are the general principles related to the chapter of PGBP, and in the next session, we'll continue this discussion by entering into the real provisions of this head of income starting from section 30. So we'll have 30, 31, 32, 30, 31 are nothing. 32 is a very major section, that is a very important thing, that is depreciation. 35 is also a very important section, that is scientific research, and there is a series of 35 series we can call it. And then after that series, 36 and 37 once again are logical type of deductions. So very particularly, if at all we look at the sections in this chapter, 32 and 35 series will be the core, and those are the biggest areas of provisions also, and problems also will definitely come from those areas. We will discuss those things in the coming classes, starting with section 30 in the next session. Till then, take care. Bye bye. Thank you very much.